Hello, I wanted to take a minute today and talk to you about risk and a contrarian approach to it that could be beneficial to optimizing the long-term growth of your account. And first, when talking about risk, I want to just get definitions on the board. We have two different types of risk, and the first one is going to be perceived. So we'll put perceived right over here. And then the second one is actual or actualized. If I can type it up. Okay, perfect. So these are our two types of risk. And to define these further, a perceived risk would be that sharks are dangerous. I'm just going to give you an analogy. Or swimming with sharks are dangerous, right? So we have our big scary shark. Ooh, wow, so scary. In actuality, shark attacks are responsible for 10 deaths. This is on average annually across the globe. Okay, so we have 10 a year. Whereas coconuts falling from trees, and yes, this is the actual statistic, are responsible for 150 deaths a year. Wow. Okay, so we have 15 times more likelihood to die from a falling coconut than from a shark attack. And this is just a common example of some of the tricks that our brain plays on us when thinking about risk and thinking about a cognitive bias called loss aversion. And loss aversion effectively states that when we win something, we're only going to be, let's say, this happy. Okay, on our emotional meter here, we're only going to be this happy. So this is happy. Whereas if we lose something, we're going to be this sad. So our sadness is much greater if we lose, or our grief is much greater if we lose, than our happiness is high if we win. And if you can counteract this and think about it in a contrarian manner, you're going to be very effective in identifying sectors or stocks or companies that become extremely profitable for you and your family long term. So an example of this would be cryptocurrency. There's an R in there for sure. So crypto was viewed as very high risk, let's say, relative to, I don't know, something like Microsoft back in maybe 2010 or 2012. Now it's clear which of these has outperformed the other. If you were invested in crypto, you'd see 10,000, this is a 10,000x returns. Whereas Microsoft, I think in the same period of time has basically doubled or just over doubled. It's up about 250% in that period of time. And this equation right here is the biggest risk that you'll ever have, okay? And that's called opportunity cost. So op cost is the only risk that you'll ever have anywhere. And I wanted to further illustrate this with, and just kind of get your idea on risk with an example. Let me see if I can find some space up here. Okay, perfect. So let's say you're playing blackjack, all right? So here's the dealer, and the dealer has an 8 of spades. Okay, we'll just say that's a spade. And you have a king of hearts. Here's a king. All right, perfect, king of hearts. So let's say you walk into this blackjack table and you have $100. Okay, you put your $100 on this blackjack hand and you hit a blackjack. So the next card comes and the next card is an ace. Congratulations, you get 2.5 your money. Okay, so you now have $250. Now let's say you were just to keep playing in this scenario and keep playing and keep playing and keep playing, but you kept winning. You just couldn't be stopped. And the casino's looking at you, the pit boss is looking at you, the floor is looking at you. Everybody's thinking, whoa, holy smokes, who is this person? Why are they so good at blackjack? You walk out of the casino with $100,000 after not having lost a hand. Okay. What would your risk be? What would you have risked in this entire experiment? Let's say that there are, I'm going to say 50. What's the math here? I'm going to say there's 40 hands. You just get blackjack every single hand. Let's say there's 40 hands. Okay. Every single hand you're risking roughly, what, $1,000? Okay. Let's just use these numbers. Let's say over 40 hands, you've risked $1,000 per hand. I shouldn't have even said risked. But think for a second. If you have to pause the video, that's fine. Just try and calculate roughly what would your total risk be? Would it be 40,000? Would it be 100,000 that you're risking? What is it? Well, there's an actual answer to this, and it's highly theoretical, so take it with a grain of salt. My answer to this would be that you risked $52 in total. So you made $100,000, and you risked 52, and by doing so, you made $100,000. Honestly, that sounds like a fair trade to me if I've ever heard one. And the reason that I think 52 is the answer is because the house has about a 52% edge in every hand of blackjack. So if you started with $100, you're risking basis points or percentage points on the hand. You're not risking actual dollars. You're only risking it if it's lost. Okay. And this is this example I gave down here of coconuts. It's only ever risk if it's actualized or if it's realized. This is the only time that risk is truly risk. So hopefully that this can kind of get your gears turning in the right direction when thinking about which stocks or which sectors to pursue. Now, I say this because I think a very common portfolio strategy is optimizing for safety. So a lot of investors, and especially a lot of older investors, will optimize for, hey, how do I just get like 6% annually, and I just get my 6%, and that's it. Well, the issue with that is you're going to go after that by pursuing companies like Apple, Microsoft. What are some other ones? Probably like Johnson and Johnson, 3M. These are going to be some of the stocks that you'll go after to pursue your 6% gain. Whereas I'll be going after the Teslas of the world that get me 23x gains. So that's 2,300% return. I'll be going after the trade desks or TTDs of the world. So these are all stocks I personally invested in at much more steeply discounted prices. This was a 2,700% increase roughly. Okay. Stocks like these are what make or break a portfolio. You cannot nickel and dime your way to wealth except through extreme periods of time. Like I'm talking like 70 plus years doing the whole 5 to 7% a year thing. It just doesn't work. And it may sound very, it may sound like hubris or hyperbolic. If you look at any of the, profitable investors that preach safety, they have different structures than you do, and they have different strategic structurings that they have to follow. You're at a big advantage by being small. This is a massive structural advantage. Warren Buffett has said this many, many times, and that he would personally gain, 80 to 100+% a year returns easily. I mean, he would just kill the S&P when he invested on his own behalf. That's because you can approach this risk profile. You can take things that others view as risky, and through a contrarian framework, you can leverage that because these things are often undertraded. And when I say undertraded, you have to keep in mind, let me find some more space, that the Apples of the world have been known. And when I say been known, everybody owns Apple, which means you have what? A word called efficiency in price. So this stock price will be extremely efficient forever and ever and ever and ever and ever. Same is true with Microsoft or any of these blue chip stocks that you want to pick. They've been around forever. They trade at extreme volumes, lots of volume, which means that they're incredibly efficiently priced. And there's very minimal room for, I would say, substantial upside. Now, sometimes, the market doesn't accurately price in just how sticky some of these products can be. We saw this in 2017 when Warren Buffett started aggressively acquiring more Apple. I think he moved from 3% of the company to like 9% of the company or something because he thought there was still much further upside to be approached. Now, generally, you as an individual investor will not be able to take advantage of things like that. Okay. Like Warren Buffett, I think, made an extra 30% over the following 24 months on this position when he could have made on one of those other stocks, like let's say TTD, you could have made like closer to 3,000%. But it would have been irresponsible for Buffett to invest in a company like TTD because they didn't have the liquidity or the volume of trade. If Buffett wanted to acquire 9% of TTD, it's only like $10 million at that point because it was like a $100 million company. Whereas 9% of Apple is billions and billions and billions of dollars. So there's a distinct structural disadvantage to being big, into managing lots and lots of people's assets. You're responsible for all sorts of different things, for regulatory concerns, for investor concerns, for um, appeasing board members. All sorts of different things come into play. And that's why these guys like Warren Buffett have always preached. And keep in mind, Warren Buffett's always gotten 20%, which is a far cry from the 5 or 7% that I think a lot of investors shoot for. So you should be investing with the intention not of getting, quick little 5 to 6% returns, and I'm going to nickel and dime my way to being a hectomillionaire. You should be investing with the intention of hitting grand slam home runs. This is you rounding the bases after you just hit it 500 feet out of the ballpark, and all the fans are applauding and screaming and cheering your name. That's what you should be approaching, is the grand slam investments. And by taking this profile of risk, and hopefully our earlier definitions help you understand that sometimes people will look at an asset class like cryptocurrency and they'll think that there's more perceived risk than actual risk. Let me go back down here. Okay, where are we? Yeah, whatever. Okay. I think we're down even further. Yeah, here we go. Yeah, so there's more perceived risk here in the eyes of the public of crypto, of growth stocks or tech stocks, of what else? Yeah, let's just use those, right? Due to the 2000, .com bubble, due to the crypto crash of 17, whatever. Like all these different things come into people's heads when they think about perceived versus actual risk. The actual risk is just your opportunity cost, in summary. Getting 5% a year when you could have been getting 300% a year will kill a portfolio, and it will set you back decades. So hopefully this is a helpful framework to approaching different investment classes, different asset classes, and different stocks, different sectors. And I do just want to make one amendment to that. Obviously, in the cases of the Apples, in the cases of the Microsoft, there is such a thing as growth investing versus value investing. So I'm not knocking any value investor. There are plenty of hectobillionaire value investors like Buffett or Graham or Fisher or any of those guys. So I totally respect that. I'm just saying that you as an individual have a much harder time identifying value because there's a informational arbitrage that you're just not able to access, and that's okay. Through dark pools, through potentially gray edges, right? Think Stephen A. Cohen. I'm not trying to get sued. I love Stephen A. Cohen. So if you're watching this, gray edges, which would be things like insider trading. Okay. These are just things that you'll never be made aware of and as an individual investor, and you don't need to, because you don't need to invest for value. You need to invest for growth and knock things out of the park and get grand slam home runs. Thanks for watching.